Hare Krishna, Krishna Krishna, Hare Hare, Hare Rama, Rama Rama, Hare Hare, Hare Krishna, Krishna Krishna, Hare Hare, Hare Rama, Rama Rama, Hare Hare. Okay, Hare Krishna devotees, welcome back in the second part of the seminar. And so I hope you all had a nice prasadam. And I also heard Katha, Govardhan Lila Katha, because yesterday, day 7 of Vraj Mandal Yatra. So every day I'm following that. And yesterday night it was Govardhan Yatra Katha. So I relished a little bit during the break. Okay, so as we discussed in last session about the principles which we need to believe and follow in order to have a stress-free financial life. So keeping that as the foundation and the base, now we'll get into the specifics. And going forward, whatever we are going to discuss is related to US, because so far whatever we have discussed was related to principles. Those remain constant no matter in which country you are in the world. But going forward, now we get into the specifics. So specifics are country specific because each country has their own rules, their own market, their own financial products. So now we'll focus our discussion specifically on US going forward. And but principle remains same. So even if you go back to India or even if you are in any other country, those principles are eternal because they come from Bhagavatam. So there is no difference based on time, place, or circumstance in those. But the implementation, practical aspect of it will adjust according to country and time. So we discuss about the personal like this compound interest in last session. And so we said that, okay, ideal is to start it as soon as possible so that we get the maximum time to realize it. But what if we are late? So if we plant any tree, so base time to plant, let's say oak tree was 20 years ago, so that by this time it would have matured and we could be ready to get its fruits. But the second best time is today. So it's better late than never. So we start from wherever we have left or wherever we can start, and then we move forward. So now again, though this topic is very vast, like normally if somebody do certification in personal finance, this is minimum 6 months course, which I'm trying to compress in these 5 sessions. So we will touch upon the concepts at a high level, and based on the individual situation, you can see that how you adopt those. And if there is any confusion or there is any question where we want to discuss one-on-one, as I said that I am available and we can discuss your personal situation in more detail. And based on that, we can take more specific actions. But as I said that as a awareness, I want to expose you to all the aspects of it so that you are aware, and then you can choose that what fits your situation, what does not fit your situation. And based on that, you can make decisions. So when we talk about financial goals, especially for devotees, again, based on same principle that basic necessities and whatever is needed. So based on that, we have following financial goals, which we need to plan for. So first one, most important is the retirement. Why it is so? Because in today's time now, retirement is totally different. It's not like previous generation. In our previous generation, retirement was mostly provident fund or the pension from the government. Or if it was business family, then our traditional method of retirement was that our children or son will become that as they grow and we retired, he will take over, and then we can depend on him or her, and then or some pension or whatever savings I have little bit, I can survive with that. But in today's time, even in India, there is no pension nowadays, and there is very little security in terms of family structure and all, because most of the children are living away from their parents. They have their own responsibilities and things to do. So we may not rely completely on that traditional route. And again, in US, though we have social security, but again, there is no guarantee on that, and it may not be sufficient. It may be sufficient, but it may not be sufficient. So we have to plan for retirement, looking at what all options we have. So that is very basic need. And especially, as I mentioned earlier, like my Guru Maharaj wish was also that we don't want to be burden on anybody when we become vanprasthi or retire. Not only on our family or children, but also on ISKCON as a society, because we should not look forward to institution as our maintainer. Rather, we should be in a position that I am available to serve. I can take care of myself, and on top of that, I am ready to support the temple or the project or the community where I'm working, even financially. And I'm just ready to serve. I'm just here to serve. So if with that attitude, if we go anywhere, then there is no problem. Like, there are plenty of opportunities to serve all over the world. And so that is the idea. Like, we want to have financial security at our back, so that we are not financially dependent on anybody. Then we need a house for shelter. So again, just a house where we can live. It's not mean that we need a luxury villa or we need more than one houses or things like that. So we just need a house which we can call as our shelter, where we can live, so that we don't have to pay continuously paying rent for rest of our life and get stressed about that. Then children education, that is another key area where we want to plan, that we want to get them educated. But again, we will see that based on the principles, Krishna conscious principle, how we can have good children education without breaking the bank, without breaking our retirement. Then we definitely have to keep charity as one of our financial goal as a devotees. It's not like that we just want to take care of ourselves and just spend everything on our own needs and requirements. We have to keep focus that how we can contribute maximum towards our goals for charities, so that we can try to help devotees, projects and temples wherever we are, to best of our ability. Sorry. Yeah. And then last is children's marriage. So when we come to it, I will share you like financially why it is not an important goal for us. I kept it here because this is there on the minds of many devotees. But when we come to that, we'll discuss that why financially it's not a big concern as a devotee. As a materialist, I totally understand that that is top of their agenda. But as a devotee, it's not a big concern for us.
Hare Krishna, Prabhu, Vibhu Chaitanya Das from Chicago. Just can I ask you a quick question?
Sure, Prabhu.
Prabhu, retirement, you are speaking about retirement early. Are you also going to cover how we can get the medical insurance?
Yes, I will cover that.
Okay, thank you.
Yeah. Okay, so let's come to that. So first thing first is that if we think that we are not able to save even 10% of our income, then how do I go about saving at all? Because I got some feedback that around 20% of the devotees mentioned in the survey that they are struggling to save at least 10% of their income. So, because that is the idea, as I said in that example, that if somebody is earning $60,000 per year, then if minimum 10%, like 6,000, if he save for 28 years, then he could have $1 million by the retirement. So that is the threshold. That is the minimum criteria, that at least 10% we want to save towards our retirement. So if somebody is in that boat that I don't even have 10% to save for my retirement, then where do I get that money from? So very simple solution for that. What is that solution? Pay yourself 10% first. What does it mean? That pay yourself 10% first means pay yourself literally. It's not for anybody, it's not for anything else. Even before spending a single penny, you take 10% for yourself. That's what practically it means. And if you are really struggling, then I would suggest that the simplest way to do it, set up auto transfer or credit to a separate bank account. 10% amount directly goes out of your paycheck, doesn't even come to your checking or savings account. It directly goes into a separate account. And then we'll use that for long-term investment or the retirement investment. Okay. So now
Prabhu,
you
10% of a net pay or 10% of before the taxes?
gross before tax. So long-term investment means, again, as we discussed, that earns compounded interest and then provide recurring income in the future. So during our working years, we put that 10% into something which earns a compound interest. And then once our working years are over, then we can use that savings to provide us a recurring income monthly in our retirement. So how will you get this 10%? So simplest, as I said, that pay yourself first. And imagine that if you get a pay cut. So tomorrow you get a pay cut that 10% your salary is reduced, then what you will do? Nothing. You will still manage. You will still survive, right? So take voluntary cut before it comes in some other way. So you can take voluntary cut if you are not able to save 10%. Take voluntary cut that no matter what, I am earning 10% less. That's it. Now let's do what I can do with remaining. So that's why, again, budgeting is very important. If you have done the budget exercise, then you can easily figure out whether you can really save 10%, or if not, then from where you can get it. So what we will do with this 10% is that we'll invest equity every month. So we'll come to that, what equity is and how to do that. And historically, it has been proven that equity will always outbid every other form of investment. So I will show you with that data. So it's a proven fact that over the last 60 years, 70, 80 years history, if we see, then equity has outperformed any other class of investment. So that's why we want to pick that as our vehicle for generating retirement income. So the key, again, repeatedly, this is coming again and again, that key is long term. Remember the formula of compound interest, the exponent is years. So the more time you spend, the more returns you will get. So key is long term. We are not talking about 1 year, 2 year or short term return. We are talking about 15, 20, 25 or even beyond.
Hare Krishna, Prabhuji.
Yeah.
Prabhuji, is this after 401k or?
Yeah, we'll come to that. I will explain how to do that. Yeah. So then returns on long term is average around 8 to 10% on equity. So again, we are talking in terms of CAGR. So it's not simple interest. It's a compounded annual growth rate return of 8 to 10% in equity. And generally Indians, it is a data that 4 to 5% saved in equity and rest in debt, like fixed incomes, deposits, and traditionally, like not when we come to US, but even before in India, traditionally people don't invest in equity. Only in last 10, 15 years, it has got some attention. But before that, it was mostly Indians were not investing, like retail investors were not investing in equity. But in US, country like US, directly or indirectly, almost 30 to 40%, 50% of their savings goes in equity. So let's look at some of this. So if you look at this chart, then this is the chart of S&P 500 index, which is a very popular index in US. It is a 1 year chart. So if you see this 1 year chart, it has lots of up and down, and it shows here in middle the dip of March. Like in March, due to COVID, that big collapse happened. So you see that dip there in the middle, and then it rose again. So if we look at it 1 year graph, then it shows lots of ups and downs, and the downs could be very significant in some cases. Like in this case, it was 30% in just 1 month. But if you look at 10-year graph, then you just see here. So this 10-year graph, it's almost like an exponential graph. if you see here. And in this, you see this dip, the March dip at the very right hand corner. So this dip also looks very insignificant when you look at the 10-year time frame. But when you look at 1-year time frame here, then that dip look very significant. So like here, this dip, this looks significant as in context of this 10-year. But here, this dip look very significant because from here you came down to here. So that's why long term is the key. If you look at long term, then equity graph is almost like an exponential graph. And you will have ups and downs in between, but overall, you will see an exponential growth. So look at some other asset class. So if you look at inflation in US is around 1 and 2%. And if you look at the return of gold, then it's around 6 to 7%. Bank FDs like certificate of deposit, what you call in US, right now it is even less than 1%. If you look at the government bonds, municipal bonds, things like that, they generate around 3 to 5%. But equity outperforms them all with return of about 8 to 10%. And we don't have to be greedy. As I said that with just 7% return, I told you in that previous example that you can get $1 million if you start at age 23. So we have to be even if we take very conservative estimate, we will achieve our goal. So we don't have to be very, what I can say that exotic to achieve our goal. Now look at this. So this is the graph of gold. So again, if you look at 10-year graph of gold, it has its own peaks and valleys. So it's not exponential, it's not even a straight line. So it has own peaks and valleys. If you time it well, then you could have got a good return, but otherwise it's both has peaks and valleys. Similarly, if you look at bonds also has its own peaks and valleys. So again, it's not a straightforward return, like you always get better return. So some may ask like why equity outperforms every other form of investment. So let's understand how the financial or economy works and how the cycle of the money is. So equity is going to outperform always because it is at the top of the chain as far as returns are like generating returns are concerned. So money starts with, let's say, from the bank. You put your money in the bank gives you 0% or 0.1%. They lend it to others. Let's say in this case, entrepreneurs for 7%, 8% or 10%, whatever that rate is. Then an entrepreneur, industrialist take that money and then he do some business. And then he repays that loan, giving the interest of 8 to 10%. And then on top of that, it generates a return, a profit for the business. So it means that it's sitting at the top of the chain as far as generating money out of money is concerned. So a good business which is generating money year after year, generating profit year after year, it's always going to outbid whether it's bonds, whether it's gold, or whether it's FDs or any other form of investment. Another way to look at it is that what is equity? Equity is the investment in the companies. And what does company do? They sell product and services. And what those product and services, who uses it? Every common man, every human being on this planet uses those products and services. And this world is not Krishna conscious. This world is primarily materialistic world. So everybody is spending money on these products and services. So they want to, these companies are extracting money out of the common people by using their products and services, generating profits, and that's how they are making money. So if whole world become Krishna conscious, truly Krishna conscious, then yes, equity may not outperform, but that is a long shot away. As long as people are consuming, as long as people are spending money on all this recreation and other unnecessary things, these companies will keep on making money, and even the necessary things, like even for housing, food and all, there are companies, there are businesses. So they will also generate profit. So all sorts of companies are there. So we just have to use that to our advantage. We don't want to use their product and services, but we can definitely invest in their business and get share of profit from that. And we will see how we do that systematically without getting too much hassles and too much uh, tension. So, and again, like inflation is more on medical and housing, but general inflation is very less. It's not too much. So, like inflation on food, gas, utilities, that is in the range of 1 to 2%. I'm living here since last 8 years, and I've not seen prices of groceries and other necessary things has gone up too much. Like it's almost kind of same as I was paying 8 years back. So that's why it's very important that we look at equity as our vehicle to get to our goal. So now the question is, how do we invest? How do we take exposure in equity? So there are various options for that. We will go one by one. So first one is mutual fund. So what is a mutual fund? Mutual is a collective fund where underlying assets are from various companies. Like it's not just one company or one stock. Mutual fund means a collection of various companies. So look at it like this, that there is a speedboat in a big ocean. There is one single speedboat in a big ocean versus a container which is carrying hundreds and thousands of container goods from various companies. So if there is any storm in the sea, then this single speedboat is very susceptible to drown or get damaged. But that big container ship which is carrying hundreds and thousands of containers on it, it will be more stable. Like by storm, it won't be get affected that much. The only thing is that speedboat may travel very fast and then container will move steadily and slowly. But another thing is that speedboats may go up to a certain point, but this container can go from one continent to another. So the principle is slow and steady win the race. The same story of hare and tortoise, which we heard in our elementary school. So we have to take that approach, that slow and steady wins the race. So mutual fund is that. But in US, the actively managed mutual fund, like which are managed by fund managers, they are costly because human cost is very costly in US. So they charge like good amount of money to manage these funds. And history and the data proves that these funds are not able to beat the indexes, the common indexes by a big margin. So what is the alternative for us? Then another alternative is index fund. So what is this index fund? It is passively managed, mimicking a standard index on the market. So if you are aware that there are various indexes in the market like S&P 500, then there is a Dow, then there is Nasdaq 100, Russell 1000, Russell 2000. So these are all various indexes in the market, and these indexes are nothing but collection of companies, and they have their weightages, and they have very stringent criteria of who can come into the index and who will follow index. So all these companies in that index, depending upon what index it is, it will have the very, very good companies out of the entire universe. So a carefully selected index fund with good track record will give us access to hundreds and thousands of companies. So we don't have to pick one company, or we don't have to research thousands of stocks to find out which stock I want to invest in. We can simply rely on an index fund, which will automatically give us indirect exposure to hundreds and thousands of companies. So if you talk about index fund, in index fund now, there are basically three categories. So first is debt and bond funds. So these are primarily funds which invest only in the debt instrument, like fixed income instruments like bonds. So they have no equity exposure. Then second is like hybrid funds. So these are very popular, where you have this target retirement series funds, like depending upon the age or year of your retirement, you have the funds which are targeted towards that particular date. So these are hybrid because they have both. They have the component of equity as well as component of debt or fixed income. And then you have pure equity index funds where everything is invested in equity. So as I mentioned, in hybrid fund, they are balanced funds. So it means that the advantage of it is that it automatically rebalance as we move forward. So let's say you started investing in, you are 30 years old and your retirement age is 60. So you start investing in 2050 retirement fund. So 30 years from now. So as you get closer to 2050, every 2 years or 3 years, this fund will rebalance its assets. So the younger you are, more risk you can take. So more equity you can have. And as you move towards your retirement, you shift your equity investment more towards debt instrument, which is less risky. So that means you preserve your gains which you get out of equity, and you don't lose it due to some sudden crash in the market nearing your retirement. Because imagine a scenario that you are building your retirement corpus, you are investing regularly, you are doing everything is nice, but just 2 years before your retirement, it's a scenario like 2008 or just like 2020 March, then in one shot, your entire investment can go down by 30, 40, 50%. So to safeguard that, these retirement funds or the hybrid funds come to our rescue. And then in equity, you have funds like diversified funds, which invest across the market, or you can have a very concentrated fund which invest only in a specific sector, like pharma, let's say. So some fund may be only for investing in pharma companies. Some may be only investing in technology companies. Some may be only investing in utility companies. Some may be only investing in, let's say, daily needs like staples, consumer staple company. So like that, there could be various sector specific fund also, but they are high risky, because if one particular sector goes wrong, then those funds will collapse immediately. But in diversified, since you are having various sectors, so even if one sector goes wrong, if other sectors perform well, then overall you will have a balanced return. And it's rarely happened that all the sectors of the economy performs bad at the same time, because there will be always some sectors who outperform other sectors. So there is a cycle which goes on in the economy. So if we are in a diversified fund, then we can have a balanced return year after year without worrying too much. So as I explained that it consists of hundreds and thousands of companies to take care of the risk. So we are not investing in one or few handful of stocks. We are investing in hundreds of stocks at the same time. Then it managed based on the company's performance without any personal bias. So they have a very set criteria for entry and exit from the index. That somebody is making that decision based on his own personal intelligence or his own personal bias. So it's all mathematical, it's all analytical. So there is no personal decision involved here. So it's very consistent. And then it has lowest cost because there is no person involved. So no fees, no salaries has to be paid to make those decisions or manage that. That's why the cost on these funds are very, very low, like almost negligible. There are some even zero cost funds are available, which charge no cost at all. And the most important is that it's a hands-off investment, that we are not making decision every day. We are not watching market every day. We are not getting bogged down how my investment is working, what this company is doing. Any news we don't have to follow, any newspaper we don't have to read, any prices we don't have to trade. So it's a hands-off investment. So that's why it's very, very conducive for us. So it's like putting your investment on an autopilot. So when the plane is what the pilot needs to do, he has to be most attentive when the plane takes off and when planes land. In between, if there is no outside factor like bad weather or anything like that, or any message from controller, then he don't have to do practically anything. So like that, we just have to take care when we start the investment, make the decision, set it up, and then we have to take when we are ready to withdraw. at that time, then we have to do. And in between, if there is any disturbance due to outside events, like there is a sudden crash or there is a certain such extraordinary event happen, then only we have to look at it. And again, I'm not saying that we have to take any action. We just have to have a look at it and see whether we have to do any action or we are good. Otherwise, it's like a hands off, like just like an autopilot, that you just start it off, let it sail through, and then once we reach the destination, before that we will try to take the withdrawal, and then we'll take the action. So some more classification, again, it's just for the awareness and information. So by asset class, if we classify these funds, then again, as I said, the debt funds, hybrid funds, equity funds. So again, in that we can have various varieties. So like in debt funds, we can have short-term funds. So they are again less risky. Again, like debt funds can be risky too, because these funds are dependent on the interest rate set by the Reserve Bank, like the federal in this case. So short-term funds are less risky. Medium-term funds are even more risky, and the long-term funds could be highest risk in this category. So their risk is less than equity, but it's not totally risk-free. Within the debt funds, short terms are the least risky, medium term are more riskier than that, and the long-term bonds are the most risky. Then in hybrid funds, as I said, debt-oriented can be where debt percentage is higher. So when you reach near to your retirement, you will have more like a debt-oriented equity fund, hybrid fund. And when you are younger, then you will have more like a equity-oriented hybrid fund. And then in pure equity fund also, you can have like large cap equity fund, index fund, which primarily invest in large cap companies like S&P 500. So it picks top 500 companies as per the market capitalization. Then you can have total market fund, which invest across the market spectrum, whether it's large cap, middle cap, small cap, doesn't matter. Like all the companies which are listed in the market, which are profitable, it invests in all. Then there could be specific mid and small cap funds, which invest only in small and very small, tiny companies. They don't invest in large cap companies. So again, they can be more risky. And then, as I said, sector specific funds, which primarily cater to a specific sector, not like across the board. And then we can have gold funds too. So it's not like that we have to go for physical gold. There are funds which invest in gold as asset as well. So another way to look at it, the classification by management style and how they are traded. So as I just talked about index funds. So in index fund, we can have various index funds based on the particular index they are tracking. So there could be NASDAQ 100 index fund. There could be S&P 500 index fund. There could be total stock index fund, and like that. There are hundreds of indexes are available in the market. And there could be exchange traded fund. So again, another variety of index fund is exchange traded fund. So what does it mean? Though they are mutual fund technically, but they can be traded like a stock on any brokerage house, just like a stock. Just like you buy and sell stocks, you can buy and sell mutual funds, which are called ETFs, exchange traded funds. So again, in this, all the varieties are available, whatever are there. Some of the good ETFs are in equity. The one is QQQ, which is NASDAQ 100 equity fund. Then there is a VTI, that is total market equity fund. Then there is that is large cap growth companies fund. And then there is ESGV, which is environment, socially governance like fund. So as a devotee, we want to have perspective of ethical investing, that we don't want to invest in companies which are involved in sinful activities like selling meat and tobacco, liquor, gaming, casinos, things like that. So based on that, if we take, then QQQ is very safe fund because it primarily it's NASDAQ 100 fund, which is technology and services. So all technology companies like Apple, Google, Netflix, Amazon, Facebook, So these are the companies are part of its indexes. So it don't have any of those direct companies which like McDonald's or Tyson and those kind of companies, Phyllis Morris, those who deals in tobacco, meat, and all those kind of products. VTI is a total market fund, so it will have all kind of companies. So if you pick this, then indirectly you are investing in those companies as well. Similarly, if you pick this VOOG, then it has top 500 companies by market capitalization. So if profitable companies like McDonald, Tyson, and then Lockheed Martin, which produce weapons, so those companies are, since they are top companies, they will be part of it. And more safer option is this ESGV fund. So this take care of that each company which it picks, it conforms to the environmental standards, that they are not polluting the atmosphere, they are taking care of the environment, they are socially responsible, their governance is ethical, like they are not following any wrong practices in the market or in the governance of the company. So they conforms to all those standards. So this index fund primarily invest in all those companies. Similarly, in bonds, if you look at BSV is the ticker for the short-term fund, and this AGG and BND is the ticker for long-term fund. So if we want to have less risky, very safe kind of return, then BSV is the choice. But if we take little bit risk, like for a like 2 to 4 years time frame, then we can invest in AGG or BND as well. And I will explain you like how to take exposures and how to invest in those in coming slides. Okay, so now we are clear that to invest in equity, we have to take the route of index fund or ETFs. So we don't want to invest in stocks directly, and we don't want to invest in any other route. So investing in index fund is the most cheapest and efficient way and the safe way. That is not enough. So how do we invest? So for that, we have to follow what is called systematic investment plan. And most of you may be already aware of it. That systematic investment plan is that doing systematically month after month, like at a certain duration. It could be weekly, it could be fortnightly, it could be monthly, but we are doing it in small chunks, one at a time, systematically. Like not haphazardly that I do this month, then don't do for 2 other months, then I start for a few months and then again I stop. No. Systematically, every month, month after month, year after year, I have to invest a small amount. Then another way is systematic transfer plan. So when we can use it, so let's say you have a lump sum. You have a big chunk of money. Now, if you put all that money in one shot in equity, then there is always a risk that we may lose a big percentage of it if just after investing or even few months down the line of our investment, market tanks. So we don't want to risk that. Our principle again here is that we will invest a small amount at a time. We won't invest a big amount at a time in equity due to its risky nature. So what we can do, we can put that lump sum amount in a safe debt fund or safe fixed instrument fund. And from there, we can slowly transfer to the equity fund. So depending upon how much amount you have, maybe we can shift it in next 6 months, next 1 year, next 2 year, next 3 year. So like that, we can take a time frame, we can divide the amount by that duration, and then every month, slowly we can transfer. And similarly, when it comes to withdrawal, so this is the investment part. Now, when money grows, then we want to take it out as well. So when we want to take it out, again, we will do it systematically. We don't want to do it one chunk that I got $1 million, I take out $1 million and put it in my savings bank. No, that's not going to do any good. So even at that time, we will follow the systematic approach that we'll start withdrawing slowly every month based on our need. So we will fix that, okay, how much is expenses I have, and depending upon that expenses, I will slowly start withdrawing amount from that month after month. So it's like that initial years you invest, you build, you reach a peak, and then from that point onward, you take retirement and then you start withdrawing, And then by the end of your life, you again reach to, let's say, zero sum. So you start from zero, reach the peak, and then you again reach kind of zero by the end of your life. So that is how we are going to make it work. So just to give a pictorial view of what systematic investment plan means, that you put fixed dollar amount at regular monthly intervals, and then you take advantage of markets up and down, because equity market is never fixed even for a minute. Every minute it's fluctuating. Every day there is some change, either it's up or it's down. So we cannot time the market. We cannot wait that, hey, I will invest when the market is lowest, or I will take out all my money when the market is highest, because there is nothing like that. Nobody in this world can predict what is going to happen next half an hour in the stock market. Nobody, because there are so many variable factors are involved. Hundreds and thousands of traders and people are operating it. There is no one person, no one institution is controlling it. So nobody can predict. So that's why we have to get out of this business of timing the market. No matter what, whether it's going up or down, we stick to our plan, and based on that plan, we'll keep on investing. So look at this. So let's say you start investing here. You put $1,000 per month when the price of that fund was $10. And then over the period of next 6 months, the price will change every month. So let's assume the price change $14 next month, then it come down to $9, then like that it was going up and down. Now, over a period of 8 months, you invested total $8,000, $1,000 per month. You invest $10 per unit, $14 per unit, $9 per unit. So like that you invested $8,000 for 8 months. Now let's assume that after 8 months, the price of that particular fund became the same. Like in January also it was $10, and let's say in August also it was $10. So if you invest your $8,000 is one lump sum at this point, and then after 8 months you are again sitting on $8,000 because the price is still the same. So your return is zero, no return. But if you follow this systematic approach, then you are taking advantage of all the ups and downs, then your rate of return after 8 months is 4.07%. So that is the advantage of dollar cost averaging. Technically, this term is called dollar cost averaging or systematic investment plan. So this is what the advantage of it, that we are not timing the market. We are not stressed when market is up, when market is down. And we are investing across the market cycles, no matter what it is. Because why? We know that in long term, it's going in one direction. And our goal is long term. We are not withdrawing anything in 6 months or 8 months. We are withdrawing after 20 years, 25 years, 15 years. So we don't have to worry for this short-term movement and keep our focus on the long term. Okay, so now let's look at where to go. So as I said that we discussed, we are going to invest in equity. We are going to invest it in systematically, but what, where, and how? So these are some of the options. So number one option, which is very popular, very efficient, is individual retirement accounts, which are like 401k, personal IRA or Roth IRA. Then second, we can take index ETFs directly, like we can invest in index ETFs on our own. And the third option, we can invest in index universal life insurance, which is called IUL. And we'll discuss about all these three in more detail. But I do not recommend you invest in pure equities or any other pure equity related products, because that is not for us. It is not efficient for us. It will cause more anxiety to us. It will cause more tension to us, more stress to us. And we don't want any of that. We want to invest in equity, but we want to invest in equity which gives us no tension, no headache, no entanglement, no kind of anxiety every day, every night. Okay.
Hare Krishna, Prabhu. Prabhu,
Yes.
so when we are on a visa H1, so 401k, I need some guidance on that.
Yeah, I will talk about it probably. Okay. Next slide is about that. Yeah, so we'll talk about that. Okay, so let's look at all these three in a little bit more detail. So we'll see the pros and cons of all three, and then you can see which situation which fits your goals or your situation best, and then you can take advantage accordingly. So I will tell you the pros and cons of all these three options in a summarized manner. So first, IRA. The best advantage of IRA is that it's aligned with the concept or principle which we just discussed, that systematic investment in small amounts month after month, year after year throughout your working life cycle. So IRA fits that bill very perfectly, because from every your paycheck, you contribute a amount and then you invest that. So it's disciplined automatically. It goes out of your paycheck before coming into your hands. So no question of spending it anywhere else. It's a long term. You can't take that money out before retirement. So it will give you long-term perspective. And it's a systematic small chunks. You are not putting all your money in one shot. So you are doing a small amount, few $100 every month, every paycheck. You get upfront tax savings from it, because all this money which you put in IRA, especially in 401ks, you can tax on that because it comes as a pre-tax money. It's very low cost, because generally employers who manage 401k, they have the bargaining power with big fund houses, because all their employees, thousands of employees are participating in that. So generally costs are very, very less. And on top of that, we get most of the time, most of the employers offer free. Like if you contribute 6%, let's say, of your income to 401k, then employers can offer a 3% match, something like that. Each company has their own different rules, but mostly company offers like at least half of what you contribute. And if you don't participate in 401k, then you lose that benefit. So it's a free money which comes from employer as a perk. Use it. If you don't use it, you don't get it. And then you can get global equity exposure. On the options your employers is offering, there you can choose a fund which invests across the world, not just US, not just India, one particular country or geography. So even in one country is going wrong for some reason, the entire world is not going to go collapse in one day. So we can take exposure globally through this route in a very low cost and efficient manner. But then what are some cons, like some not so good features about it? That it's not too flexible. Since it's a retirement account and government is giving the tax benefit on it, then the conditions are that you cannot withdraw from it before you reach age 59 and a half. And if you do that, then you have to pay 10% penalty along with tax. Tax anyway you have to pay. So that is second con, that it is taxable at withdrawal. It's not taxable at the time of investment. You save tax, but it's taxable at withdrawal. So the way it can benefit us for devotees especially, since we don't want to work too long, we are not planning to work for our entire life till the tail end of our life, then whatever tax we are paying, tax bracket we are in right now, probability is that we will be in a nil to very low tax bracket at the time of retirement. So at that time, even though money is taxable at withdrawal, we may not need to pay any tax or a very little tax as compared to what we are paying now. Because mostly people right now may be in 12 to 20%, 22% tax bracket, but at the time of retirement, we can be in nil tax bracket. Let's say, for example, if you are withdrawing only $32,000 per year for as a couple, then you don't have to pay any tax. Another con is that its only options are based on employer. So you are stuck with the options which are given by employer. Sometimes, mostly I found in my review that options are really very good. But sometimes it may happen that since if your employer is very small or they are not having too many options to invest in, then you have to pick from whatever employer is offering. And then you have to roll over it if you make job changes. Since it's attached to your employer, anytime you make a job change, you have to make sure that you take your 401k with you. Don't just leave it. Don't just forget about it. So every time you make a job change, and if you have contributed to 401k, you have to make sure that after you join to the next employer, you formally and take it over. You transfer it to the new 401k. And the another drawback is that it's subjected to various rules, regulation, and tax law changes. Because as government is giving tax break on this, they control and they define rules and they define regulation. And right now, tax laws are like that you get the tax benefit at the time of investment, you are taxable at the withdrawal, but all those things are subjected to change as we move forward. So it's just that one thing we have to take into account. So my recommendation is that IRA, if it is available through employer, and especially if you are having free matching from the employer, then you should definitely make use of it. And concern that if I am on H1 or I am short term here, I don't have any visibility, then as I said, in worst case, you can withdraw from it by paying 10% penalty and tax. So now look at the scenario that you are on H1, you contributed for 4 years in 401k. So two things you got upfront. You got upfront tax saving. Let's say you are in 20% tax bracket. So you got 20% saving upfront. And then you got free matching from the employer. So let's say you invested $6,000 per year, you save 20%, that is $1,200. And then on top of that, you got 50% matching from employer, that is $3,000. So out of your $6,000 investment, you got $4,200 already. So even if you have to pay 10% tax penalty, you are going to pay only $600. So you are still in huge profit, even without getting any profit from the market, just keeping simple plain money. Second thing, you are on H1 or something, and then you have to leave the country because you are not working here anymore, then your US income becomes zero. And once your US income becomes zero, if you withdraw from it, then if you are even single, then for single also up to $18,000, there is no tax, taking standard deduction and other things into account. So you can withdraw that much money every year with just by paying 10% penalty, and then you can take that money, or you can keep this money invested as long as you have got the SSN, which you have since you are working. You can keep this forever here. Even if you leave the job, you don't have to close your 401k. You can keep your 401k either with your existing employer, or you can transfer it to any private bank. And they may charge you a little bit extra since you are not an employee anymore, but its money is not lost. It's not gone anywhere. It's your money. You can keep it or you can take it. It's up to you. Now let's say second option I've talked about is equity traded fund.
Prabhu,
Yes,
Krishna, Prabhu.
Yeah.
If employer is not matching, will it be worth investing also?
Yeah, so if employer is not matching, then you have to look at your tax bracket. So if your tax bracket is high, then it will make sense. But if you are earning, let's say up to 30, 40,000 or 50,000, and you are filing merit jointly, then it won't provide much tax benefit also, right? So in that case, instead of going for 401k, you may go for Roth IRA. Yeah.
And if you are into 20 or 30% bracket, then it will make sense.
Yeah, because you are upfront savings that much, and as a retiree or as a devotee, we don't want to retire with too much money anyway. So we don't get too much income in retirement age, because here people follow different strategy, because even in their retirement, they are working. They keep working till 70, 75 because they don't have any other thing to do. They get social security, they are working, and then top of that, they have some other investment as well. So then they are afraid that they may have to pay even more tax at the time of retirement. But in our situation, if you are following the principles, then we will be in a situation where we don't have to pay much tax at retirement. So it's better to save upfront now.
Okay, Prabhu. Thank you.
Yeah.
Hare Krishna, Prabhuji.
Yes.
Prabhuji, do you have any recommendations for IRA accounts if you don't have a 401k account from employer like that?
Yeah, so you can open any like either with Fidelity or Vanguard. They offer individual accounts.
Okay, Prabhuji. Do they charge fees and stuff like that, Prabhuji?
Yeah, there would be little bit fee, but again, it depends on the fund. So as we said that if we choose the
Okay.
index fund, and especially in that if we choose target retirement series fund, then they are generally very, very low cost, like 0.05, 0.07, something like that %.
Okay. Thank you.
Yeah. Yeah.
Hare Krishna, Prabhu, IRA, the Roth IRA, you pay tax before, right?
Yes, so Roth IRA, yeah. So
you-
that's why I said that if you're not giving too much upfront tax saving, then you can invest in Roth IRA, because anyway you are not getting tax saving. So you don't want to restrict yourself till 59 and a half. Instead, you can invest in Roth IRA so that it's more flexible.
Prabhu, if employer is not providing, for example, if we flip the jobs around and employer is not providing, what is the solution you suggest, Prabhu, to get the tax benefit like that, what you said?
Then it's difficult because generally they offer tax break only if you contribute to these funds.
Okay, only through employer only we can get this.
As far as I know, yes, but there is some option like, so there are two things, like if you are self-employed, like you are not getting salary, then you can open your own individual IRA and then you can contribute on your own and then you can get the same benefit. But if you are salaried, then I think there are some restrictions. I have to research more on that because I don't want to misguide you.
Okay,
But if you are salaried and if your employer is not offering 401k, there are some options, but they are not very straightforward.
Okay, Prabhu.
Yeah.
Prabhuji, one question. Sorry, please
Yes,
go ahead.
Prabhu.
Yeah, Hare Krishna, Prabhu. What is the drawback of leaving the 401k account with the previous employer and opening the new 401k with the new employer?
So one disadvantage is that as soon as you are not an employee, then they will charge you the fees. They will start charging you account maintenance fees and other charges. So you would be paying more to maintain the account. And again, the headache of maintaining multiple accounts. Like you already have got new one at new employer and then the one is already there with previous employer. So you have to keep monitoring that as well. So
Okay.
that's the overhead. That's the overhead.
So I think the rollover will basically, rather than withdrawing the fund to our checking or saving accounts, we can get it rollover or transfer to the new 401k.
Yes. Yeah, it's a rollover only, because if you don't roll it over, then it comes as a withdrawal and then you will be subjected to penalty, tax and withheld and everything. So you have to tell your employer, both new and old, that I want to roll it over, and then you have to follow that process to roll it over. Then it would be no impact to you in terms of taxes or commission, like penalty or anything. The entire money from here will get transferred to there.
Hare Krishna, Prabhuji.
Yeah.
When you flip to one account to another account 401k, while switching the company, what is the difference between IRA account and 401k new employer account? Which is the best?
So IRA is a generic term, which is individual retirement account. So within IRA, then you have various options. So one of the option is 401k. And another option is like say Roth IRA. And another option is that you open your own personal IRA account with any bank or financial institution.
So I can transfer my old employee 401k to the new employee 401k.
401k, yes, that is the suggested route.
Okay. And not required to be personal. I heard that personal IRA is better to transfer it from old 401k. Is that any?
No, means because if your new employer is offering the good fund options and you are comfortable with that, there is no need to go to personal IRA.
Okay.
You can transfer to the new employer, because again that employee accounts are more cost efficient, because there you have the economy of scale. Thousands of employees are participating in it. So your employer negotiate good terms and conditions with them, and you get many other benefits like the counseling and the guidance and other benefits are also there.
Okay. And another thing is withdrawal also, I don't know. I heard this is personal IRA account has more investments options and also better in withdrawals rather than the 401k.
Yeah, so rules are same irrespective of which account it is. And as I mentioned in the cons for the IRA, that 401k IRA, that options, yes, that is a con if your employer, whatever options they're offering, If they are limited or not good enough, then that is a disadvantage. But generally, for large employers, they offer very good options.
Okay, Prabhu. Thank you.
Hare Krishna, Prabhuji.
Yes, Prabhu.
In these like 401k IRAs, also we need to choose which fund we are allocating this money
Yes.
towards, right?
Right. Yeah. So as I said, that best would be to pick the target retirement series fund. So then you don't have to worry about rebalancing automatically based on your retirement age. The funds will get balanced automatically between debt and equity. And it is the most efficient, low maintenance, low headache, low anxiety route to invest in 401k. So pick your target retirement series fund based on your current age and what date you are planning to retire. In this case, age 60, because anyway you cannot withdraw before age 60 from 401k. So pick your current age minus 60, and then whatever that year falls, the nearest of that year you pick.
Prabhuji, another thing, is it like if company matches 6% only, but still as with lack of knowledge, we put more money, should we, is it recommended to put more money, or like how is that?
Yeah, so it depends. Like as I said, maximum you can invest up to $19,500 this year if you are merit filing jointly. So that is your upper limit. So if you are comfortable, you can go and hit that upper limit. Again, it depends like how much you already have, how many years are left, and how much you have to do catch up. So let's say if you are starting very late and you don't have anything right now, and you are already 40 something, then it's better to put more. But let's say if you already have something and you have some other assets and some like that, then you can take less, like just minimum 6%.
Sir, your recommendation is like put as much as possible up to the maximum.
If you can, and if you don't have any other savings already.
Okay, Prabhuji. Thank you.
Yeah.
Hare Krishna, Prabhuji, Dandavat Pranam.
Yes.
Prabhuji, I'm currently employed, and if I decide to be a self-employed in down the line in 4 years, so what is your recommendation about 401k? Like, because once I am self-employed, right? Like, I might be incurring charges on 401k, maintaining that account.
Yeah. So maintenance charges are still very low. Like I would say $100-$150 per year, something like that. So it's not like huge cost. And once you become self-employed, then as I said, you can still maintain your private personal retirement account, just like 401k. So you can open that, and maybe you can roll over at that time from your employer 401k to that based on the cost of both accounts.
Thank you so much.
Prabhuji, Dandavat Pranam. Thank you so much for this session, Prabhu. So for you said to put everything in a retirement fund, are you suggesting to put 100% into the target retirement fund, or choose?
No, 100% in that, because it underlying, if you look at target retirement fund, it has both equity as well as bonds. So it gives you complete exposure. So we don't want to pick multiple, because if you pick multiple, then again problem would be that we have to keep looking at which is performing better, which is performing, and then you have to do manual decisions to switch over from one to another. So that will be again a headache. So better to stick with target, because on 10-year plus time frame, target fund give very decent return, like around 8 to 10%, which is our target.
Thank you, Prabhu. In that same line, like say, should we, like if the market is crashing, and we have seen, it can go down 40%, 30% and all that. What is your recommendation? Because we don't know at what point the market crashes and how much it crashes. So what should be our...
Yeah, so our approach is never time the market, because we are investing based on the goal. We are not investing based on what happens today, what happens tomorrow. So if you are, let's say in 40s and your target is 60 years, then whatever happens in 2020, it's not going to have material impact on your returns, what happens in 2040, 20 years down the line. So we don't react to market movements as long as we are not nearing our retirement. And if you invest in target retirement fund, Even at the time of nearing retirement, you don't have to worry about it, because by that time your fund would be almost 80% into bond already. So even if market tanked by 40%, your overall fund will go by only, let's say, 4% or 5%, because your 80% of your investment is already safe.
Thank you, Prabhu. This gives a good perspective. So no matter what is happening to the market, how badly it is pushing, don't touch it.
Yes, and the principle again in equity market is, when others become greedy, we have to be fearful. When others become fearful, we have to be greedy. Something so it works on that principle for a growth of investment. So if others are selling, then it's an opportunity for us, because it's a sale. Again, same example. If you are going for shopping and if you say 50% sale, so you should be excited, afraid, right? Similarly, if you are getting something $10 thing for $50, then you should be concerned that, hey, this is thing. So if some company which is worth $100 and is trading at 500, then it's a cause of concern. But if somebody is worth 100 and is trading at 50, then it's a cause of rejoice, not concern.
Thank you, Prabhu.
Krishna Prabhu, are we talking about only retirement as of now, or else kids education? Are we having some?
Yeah, we'll cover that. So yeah. So
Prabhu, one question with respect to, as you're focusing on our IRA and all this, somebody having W2 based income, they can also have a LLC potentially, and or something. So they could open based on that LLC, they could also open a SEP IRA. That has not been discussed here so far. So your thoughts on that?
So actually, I'm not aware what is LC.
LLC is the limited liability company of Illinois. Basically,
So this all this 401k, SEP IRA, and this personal IRA, they all comes under retirement account. That's 404. There is another one, 404. If you are working from some non-charitable government organization like schools, then they call it as a 404. So all these follow the same principles and same rules.
So you're saying, go ahead, please.
Yeah, but you have to read a little bit in detail, and if you want, then I can also research on your behalf. Because personally, I have not gone in detail about the SCP, but because I work in a IT company where we deal with the insurance products. So I am aware of the term, and I know that we accept payments as a tax qualified payment from SEP IRAs. So it's a qualified retirement account type, but what are other features of it as compared to normal 401k, that I have to look further.
Thank you.
Yeah, thank you,
Prabhu. Krishna Prabhuji, in even Roth IRA and the traditional IRA, we need to pick the target based. Will that be available there?
Yeah, in Roth IRA, it's an open market thing. You can pick anything from which is available in the market. So generally, you have these allocation funds or target funds to pick even in Roth IRA.
Okay, thank you, bro.
Yeah.
Hare Krishna Prabhu, what do you think of HSA and investing HSA in funds?
We'll talk about that when we talk about health insurance. And just another request, if you can switch on your video while asking questions, that will help me a lot. I would just want to connect with you personally.
Yes, Prabhu, thank you so much. So Prabhuji, thank you for the guidance on the 401k. So the traditional 401k the employer is giving, we'll do that. And if you don't have any financial hardships or anything, you recommend doing maxing out both 401k and also Roth 401k or Roth IRA, or just
because we will discuss these other options like ETFs and IUL. So based on that, after seeing the whole picture, make a decision. So technically you can both, and it's possible you can max out both, but whether it makes sense or not for your personal situation, you can make the decision after going through everything.
Thank you.
Yeah.
Hare Krishna Prabhu.
Yes, Prabhu.
Yes, please accept my humble obeisances, all glories.
Hare Krishna.
So I understand that we want to invest in the indexes and all the other products, vehicles. And why do we have to watch that index go down 20, 30, 40%? Can we just put a stop limit on all the investment that we have So once it hits that limit, automatically gets us out before going further down.
No, because again, that would qualify as timing the market, and you don't know when it's going to happen. And if you're talking about any automatic way of doing it, then at least it's not there. That if it goes down this much, then don't do.
It is there. It's there. Let's say, for example, SPY or QQQ. These are let's say, for example, it's 300 trading at 300. We can do trailing stop, or we can have hard stop, where it, let's say, goes down more than 5% or something. It gets us out right away.
But that would be more beneficial if you are doing trading, not for investing. Because since we are doing long-term investing, it doesn't matter much. And we are doing systematically one small chunk at a time. So we don't want to get into that headache and anxiety. If you are putting individual trade, and if you are doing day trading kind of thing or short-term trading kind of thing, then that those things matter. But for the kind of investment we are talking about, that is not that relevant.
Okay. And the second thing was that you mentioned investing in index funds and also like a gold and bonds and everything. How about investing in a real estate, which also gives you a nice cap rate of 7 to 10% plus gives the appreciation in the property values?
We'll talk about that. What are the disadvantages of it and why I would not recommend.
Okay. Thank you.
Yeah.
Prabhu, when we have Roth IRA, do we have those tickers to find those ETFs?
Same is applicable for Roth also.
Okay.
Yes.
Prabhuji, quick question. Earlier you spoke about how, because we are not aware of investing or equity and whatnot, we may have just some money in the bank account. But you also spoke about the principle of gradually investing, not investing at a given point of time, right?
Right.
So what would be a recommendation for that?
Okay. So your voice little bit broke, but
money but never read. Would you advise me to just spread that out also?
Yeah. So we just talk
spread that investment.
Yeah. So we just talk about that STP, systematic transfer plan, right? So you take advantage of that. So instead of putting it in one shot, you spread it out over a period to take advantage of ups and downs of the market.
Okay, thank you.
Yeah. Okay. Can we move ahead? Okay. So the second option is ETFs. So as I discussed already, they can be traded like stocks. And the pros of it is that it's no cost, practically zero cost if you use app like Robinhood, because as I said, you can trade just like stocks. You buy and sell just like stock. And using Robinhood, the advantage is that it's zero cost, absolutely zero cost, no trade commissions, account setup, any fees. And just recently, they have launched this recurring investment option. So it means that you can set up a fixed dollar amount either every day, every week, every other week, or monthly, and set it up. So you don't have to worry about doing every trade or every time you have to log in and then you have to invest. Nothing. You link your bank account and you set up the instruction that this is the ETF I want every month, every week, every bi-week, and then it will buy it for you. So it's very simple, very low, like almost no cost. So we can take advantage of that. And there is less tax or no tax at withdrawal because investment in direct ETFs counted as long-term equity tax. And in US currently, if you are earning merit filing jointly less than $80,000, then there is no tax, long-term capital tax. If you are earning more than 80,000, then it's 15% long-term capital gain tax. So again, it's very efficient. It's not linked to your total income. Like even if you are earning 200K, the tax on this income would be 15%. And let's say if we withdraw this amount later, like again, we are not doing it for short term. So when we withdraw this amount after our active income is stopped, then again our income will be very low. So at that time, practically, we can avoid paying any tax at all. Then it's completely flexible because you are putting your post-tax money in it. You are in total control. There is no government rules or regulations which is stopping from taking, withdrawing, anything. So you are in total control. It's completely flexible in that aspect. And there is no minimum amount to start. You can start from $10 or even practically $1 in Robinhood. So even you can buy fractional shares. You can say that I want to buy QQQ $20 every week or every day, and it will do it for you. So there is no minimum to start. So that's the beauty of it. But again, there are some cons. Need very strong discipline. Since you are in control, it means you have to be disciplined. Once you set it up, don't just keep on looking every on changing. Oh, today it went down. Oh, today it went up. Let me sell. Today it went down. Let me. So don't do that. Stick to plan, set it up, and then that's it. So it's need very strong discipline. You can have a short-term volatility because you are doing directly in ETF. You are directly investing in it. So you are watching. If you watch it, then it may subject to high volatility based upon the daily movements of the market, but again, it would be short term. So when you start, don't just look at it every day. That is my recommendation, because we are doing it for the peace of our mind, not to increase our anxiety. So once you set it up, then just forget about it after you set it up. And then you need to plan withdrawal at right time, since you are in control. So don't just withdraw it for any sense gratification, any buying, any purchase. Oh, after 2 years, now it is giving very good return. I got 30% return. Let me sell from it and then let me earn something. Then you lose the power of compounding because you reduce your capital, you reduce your principal. So what it can do over a period of years, it will not do. So again, we have to stick to the same principle, keep investing month after month, year after year, till the time we reach our goal. So all these things, we are using it for the long-term goal, which is retirement, or for that matter, child's education. Because if you start in any of this route, as soon as your child is born, you have at least 18 years before it goes to college. So 18 years is a long term. So you can take advantage of any of these vehicles for that purpose as well, for child's future planning as well. Then
one question on this Robinhood app.
Yeah.
There is another app which is called Betterment. They actually do the investment on your behalf. Of course, they charge you a little amount.
Right.
But it's like 401k only, just automatically does it for you, rebalancing and everything. So do you recommend that, or should you just not do that at all?
Yeah, I think there is no need since we have this option, because for that we are anyway doing 401k through our employer. If you are, let's say if you are doing that already, then this ETF, I am talking more from a flexibility point of view, and mostly, so this I will tell you later. So I will cover now. So we are targeting to retire at age 50, or let's say age 55 or whatever. And your social security starts at age 62, right? So if you are planning for early retirement, then you have to bridge that gap during those years by the time you get your IRA payouts or your social security payouts, because both will start after age 60, 62. So we can use this ETF corpus during that time to fund our intermediate years. And if you have child education, college or anything, so you can use this for that purpose as well. So since we are doing it for very long term, and anyway it's a low cost, like free of cost, and we know where we want to invest. We don't want any advice or guidance. We know the ETFs which we want to invest in. So better we can do it ourselves.
Okay, got it. Thank you.
Yeah.
So how to start the ETFs? Like, is it like once we get this Robinhood app, is it a...
Yeah, it's just like buying the stock, the ticker which I mentioned. So you just look for the ticker and then you just place the order. So it's very self-intuitive. Once you install the app, you will be able to find it out. And if not, you can just let me know and I can guide you step by step.
Okay, so Robinhood.
What is the ticker you have shared, Prabhu? Sorry.
Well,
that on the previous slide, I shared that QQQ, ESGV, and
okay. It's like an abbreviation of that particular.
Yeah, right.
Okay. So Prabhu, outside those tickers, we should not be looking much outside.
There is no need, because that one was the best one which I picked from the available universe and which aligns to our principle. So this QQQ and ESGV, that aligns to our philosophy. which does not invest in any sinful companies.
Okay, thank you.
Yeah.
QQQ is a classification of funds, or else it's a name of the fund?
Name, ticker of the fund.
Prabhu, if you already have other accounts like E-Trade or anybody other accounts, if they are not charging transaction based,
yeah,
you can stick to them, right?
Right. If they are not charging commission or trade fees or anything like that, then you can stick to them. The only thing is that since we are doing it long term, we will be doing every month, so we will be doing many transactions. So even if it is a small amount, it adds up in long term. So we just have to be careful that it's not charging anything.
Sure.
Yeah. Okay. So the third option I want to talk about, again, it's not applicable for all, but I want to make you aware so that you can make a decision if it applies to you. It is called IUL. The full form is Index Universal Life. And this comes from life insurance companies. This does not come from bank or stock brokers or anybody. It's a life insurance product. And so I will discuss few pros and cons, and then we will discuss more about it when we talk about the insurance later. So hold your questions on it for the time being till we reach to that section later in the next part or tomorrow. So at a high level, as I said, it's a life insurance product. So it provides you death and critical illness benefits. Again, it's highly flexible in terms of how much you can put in and when you can withdraw and how much you can withdraw. The another advantage is that withdrawal from it will always tax free because it's a life insurance product. So there are ways to withdraw from it without paying any tax at all, no matter what your condition is. And then funds can be used for anything like HSA or 529 or something like that, where we are restricted that you can use it only for medical purpose or college purpose or something like that. This you can use for anything. And the best of all is that it provides protection from loss. So even if market goes down, it will not lose its value. If market goes down in a particular year, you get 0% return, but it never goes negative. So that is the advantage of IUL. But it's not that it comes without any drawbacks. So there are a few drawbacks. So let's talk about those. It has a very high cost because it's a life insurance product. So first it is covering the risk of your life. So there will be charges for that. Then they will charge policy admin fees. They will charge fees for the investment on your behalf in the policy. So it has around, like I would say, around 20% of your investment amount will goes towards the cost. So if you are investing $10,000, it will be invested and 2,000 would be covers as a cost. But the good thing is if you have a horizon of 15 plus years, then this high cost will be paid off because again, power of compounding, because every year you are compounding protection from loss, that your value does not go below. It can only go up or remain constant. So with that feature, if you remain invested for 15 plus years, even if I'm paying 20% cost, it will pay off. And I will show you tomorrow with a real life example so that it will be more clear. But the only thing is that you should plan to be in US for long and preferably GC, because most of the insurance company, if you are not green card holder or if you don't have stability to remain in US, they may not issue you this policy. And another thing is young and healthy, because since it's an insurance product, the more older you are, if you have some health condition or something, so the cost will unnecessarily increase. So if you are young and healthy, and if you think of you will remain in US, you can continue paying premiums for 10 years or so, then this is definitely a very good route to go for. And again, this you can use as a vehicle for college planning for your kids. As soon as kid is born, if you take this policy, then again you have 18 years. And in 18 years, you can pay for college without giving any extra out of your pocket, just from this policy. And we'll see with real life example tomorrow when we talk about insurance. Okay, so only thing is that you have to keep paying minimum like 10 to 15 years, you have to commit to pay premiums. So that is the only thing. everything. And after that, you can stop. So you don't have to pay premium your entire life. Just commit for 10 to 15 years, and then you will be good for rest of your life.
In this policy, Prabhu, can you say tax-free withdrawals, but you can only withdraw after 10 to 15 years?
No, technically you can withdraw anytime, but again, to make advantage of power of compounding, you should wait till minimum 15 years before you start any withdrawals.
And this has to be bought through an insurance company.
Yes, life insurance company. Yes.
What does IUL again stand for, Prabhuji?
Index Universal Life. So again, there are various similar names in the market like Variable Universal Life. So don't confuse with that. Here we are specifically talking about Index Universal Life. I is the keyword here. Okay. So as I said that you need around 10K per year to be meaningful investment in it. So if you can spare this much amount every year, at least for 10 to 12 years, then this can be a fantastic vehicle to have a long-term growth.
Hare Krishna Prabhu, I have a question there.
Yes.
In the previous slide, like between choosing ETF and IUL, do you recommend doing both of them or one of them in that order?
It again depends on the goals. Like as I said, they have both a little bit cons. So ETF is completely flexible. So in that aspect, it's very fluid, very less restriction, no commitment. So from that point of view, ETF is the most flexible out of three. But IUL, as I said, it has its cons. Like you have to have minimum 15 plus years, minimum $10,000 per year to invest. And you should be young and healthy enough. And you should have visibility to pay that premium for 10 years. So if you are on H1 or something and you don't have the job visibility or you don't have visibility to stay in US, and if you buy this policy and not able to pay premium later on, then it's going to be loss-making affair, right? So based on your situation, if you fit the parameters, then you can go for both or in whatever order, you can make decision based on that. Yeah. Okay, so let's talk a little bit about, because most of us fall in this category, like which are on visas, we are NRIs, and some are US citizen, but most are on visa or green card in processing, like in that limbo status. So let's talk about, again, go back to our root, like Krishna conscious philosophy and principles, and understand like what it is. So if you remember Srila Bhaktivinoda Thakur's bhajan in Denya, Bhuliya Tumhare Sansare Asiya. So in that bhajan, he has mentioned about the life journey of an individual, like typical individual. And in that he has one verse, like one stanza, where it says that after getting educated, you are traveling country to country to earn money and forgot Krishna. I did not do any bhajan just to earn money. In the pride of my education, I am moving from country to country. So that is the thing, like we have to ask ourselves, like if we are here, for what we are here? If I am in US, for what I am in US? Is it just to earn money or to do something else? So that is the one practical thing we have to answer. Like don't be in two boats, because most of the times what happens is that we are here as long as we are here, as long as my job allowed me, as long as I'm not kicked out, as long as my visa keep on getting extended. And due to that, we are always in two boats. And since you are in two boats, you are losing the advantage of compounding. So that is very detrimental to our financial life. Though we think that by coming in US, I become financially more stable, but practically if you look at it, that's not the case. Like especially for myself, I can say, I came here 8 years ago, and if I look back, that if I would not have come here, and if I would have got this philosophy and got beforehand, before coming to US, then probably I would not have come here at all. Why? Because if I would have remained in India and I would have, like I started investing in India in 2005. and I came in 2012 to US. So I was already investing in India for 7-8 years. And then when I come here, I have a 1-year perspective so that I again keep investing in India because I knew that in 1 year or 2 years, I may again have to go back. But then slowly year after year, it got extended like everybody else. So then I stopped investing in India. Then I shift my focus towards US. Then I didn't know anything about US. Like any of you, most of you, I was in the same boat. I didn't know. I didn't contribute in my 401k for first 4 years of my job here. Again, same thing that I need to go back. So I to put money, block money for till retirement, this and that. So I made very bad decisions during that time. And then again, money was there. I was saving. Those principles were still I was following, that I have to save. I don't want to spend unnecessarily. So then I invested in real estate. And then again, those money got blocked, loss-making affairs, not yielding any return or anything. So many things like that. And then constant headache of this GC and citizenship. Because why? What does GC and citizenship can give us? Only thing is that social security, financially, if we talk about it, it's the only thing citizenship can give you. Because if you're not citizen, you are not going to get social security. But how much is that? If we follow the principles, then as I said, without any government aid, with pension plan, without any support from outside, we can build our own retirement corpus. So why just for the hook of that social security, we keep on hanging here? So again, it's a big trap. And the more time we spend here, then our family, our children, they will not allow us to go back. There may be pressure from their side. And then you lose all the relationships in India. If you want to go back, you have lost all the touch with them. If you have elder parents there, then you have to be constantly anxiety about them, their health. If there are any issues, if you are only son or only caretaker in the family, then you have to make constant trips back and forth. So much complication. And then taxation issues. Now US has made a rule that anybody who is working or any income from outside of India, they have to declare in US. So if you are maintaining assets in India, then you have to report all of those here. Same thing, if you go back to India, then you have to start reporting all the assets in US. So much headache. So ultimately, at the end of the day, net, if you see, you are not better off than what you could have been in India. And more importantly, if you would have stayed in India, if you are already working in IT, then I hope that you are already making good money over there. And if we would have followed all these principles and invest and save and stick to our basics, then easily you can make very good life over there. And here, if you come, you start again from zero. You don't have any base. Then just to make a house here and to repay that house, you keep working till age 60. And then another 10, 15 years to make your kids educated from US universities, high cost universities. So practically, whole your life you are working just to chase the US dream. Now, I'm talking to myself, like your situation may be different, but I'm talking to myself and I'm praying to Krishna that somehow make arrangements so that I can go back.
Prabhuji, you nailed it, Prabhuji, because I am in that same boat. And no, now I am 60. I am feeling I lived 30 years there in India, 30 years in US. Now I am feeling why I came here late. It's too late. I want to go back, but I cannot go back. You nailed it.
Right. Yeah. So that is the case with most of us. As I said, that you can relate with this. That's why I shared it. So again, those of us who have made the mistake, that's fine. But if we realize that it was a mistake, then at least it's our responsibility to educate others. So if there are any young professionals, any young devotee who is planning to come to US, then please counsel them, advise them, and make them aware of all these things. Because just for chasing the money, if they are coming here, then that's not a good idea. Because if you are coming here for preaching, if you are coming here to spread Krishna consciousness, if you are coming here to serve the mission, then it's a different thing. Prabhupada ji came here without anything because his intention was not to make anything here. His intention was totally different. But if our intention is to come here to make money, then that's not the only option, because US is just look outside, greener outside, but it's not that way. And
Yes,
it's a
Prabhuji,
trap of
correct.
Maya. Now we understand clearly that it's a perfect trap of Maya, that what you could have retired in 50 years, you trapped yourself to work till 70 years.
Yeah, I'm thinking of my father, Prabhuji. You know, when
Yeah.
he was retiring at 59, I used to go to his office and try to bring him back home. You know, at 59, he got retired from Chennai. And, you know, now I am 60, I can't retire.
Yeah.
I am like, you know, I made money, but I can't live here in US, but my conscience doesn't allow me to go back to India. So
Right.
I'm, you know, boat, tossing
Right.
boat.
Yeah.
So Prabhu, one quick question. You
yeah.
mentioned that green card holders will not get social security. Is that true?
Yes, you have to become citizen to qualify to get social security.
Oh, okay. I thought green card holders can get
No.
social security.
No, as of now, it doesn't allow. Citizenship is a mandatory. Only certain countries have the treaty with US government. So those, if you are citizen of those countries, then you are eligible. But India doesn't have such treaty. So for Indian citizens, unless you become US citizen, you will not get. But once you become citizen, then you can live anywhere in the world. Then you will get social security.
Okay.
So you become citizen, you are citizen, then you retire in India, go back to India, you will still get your social security in dollar here.
Okay. Thank you.
Okay, so let's discuss then principle we understood, but now we are stuck. So based on this constraint, what best we can do? So get best out of the best bargain. Is Bhakti Siddhanta Saraswati Thakur has mentioned that coming in this material world itself is a best bargain, like worst thing, but how to make best of this worst thing. So based on that same thing, let's see. So for NRIs, as I already discussed, that you can invest in IRA for sure. As I said, that worst case scenario also is beneficial. There is no loss. Money is you have to keep. Nobody is taking it away, even if you are in here or you go back to India. And if you go to leave US, go back to India, as I said, you can keep invested in personal IRA or with employer, or you can withdraw with 10% penalty and tax based on the situation. But it will still give you benefit of saving and free employer matching. So that itself will take care of any penalty or taxes you may pay later on. You can always invest in ETFs. Again, it's totally flexible. Even if you go back to India, whatever you have invested so far, you can remove it. You can sell or withdraw it anytime you want, even from India. And you can keep bank accounts in US, even if you're not residing here. There is no restriction on that. Only thing, don't go for IOL. Already I told you that if you are not sure to stay in US for considerable time, at least 10 to 12 years till the time you can pay the premiums, then don't go for it. And earlier I said it for other country citizens who are also there, but I think in this forum we are mostly Indians. So you can invest in Indian equity market through mutual funds, but again, not in your name, because as I said, due to tax laws, any investment you have in your name or your spouse name who are in US, you are subjected to declare those here. And even if you are not making any money, like even if you are not making any profit or selling it, just for having it, you have to declare it in US. And it's a big headache because I'm going through it since last 5 years. As I said that I invested in India, I started investing in India before I came to US. So all those my investments are still there. So I have to keep reporting those, and my investment, like every year, my return goes into 85 to 90 pages. So it's a big headache. And
what about properties?
Properties we'll discuss, Prabhu. It's a separate section. So yeah, property you don't have to declare, but again, there are certain rules for that. Like if it's a home, ancestral property or the investment property. So based on that, certain rules. Generally, property outside of India is not outside of US. You don't need to report on US return unless you are generating some income, active income out of it.
Okay. So one question on the 401k. So you are mainly concentrating on to gain the employer match, but
Right.
my company is not required myself to invest personal. but company itself by default, some certain number of percentage of 401k they do it in my name.
Okay.
So I don't need to invest, but company do it.
Okay.
Matching.
Yes. So just see if it is enough, like 10% rule. If that and if it gives you enough return where you can be at the time of age 60, then that's fine. But if you think that you will fall short, then you can put some from your side.
Okay.
And I have shared some sheets with you. So in that there is one sheet that compound return calculations, like compound interest calculations, that sheet. So in that sheet you can put your numbers and then you can calculate your figures. Like if you are investing, let's say 6,000 per year or 7,000 per year or 10,000 per year, this much, what is your current age, how many years you have, and let's say if you get 7% return, so where you will reach. So based on that, you can adjust those numbers and determine your goal and the target, how much you have to invest every month.
Okay.
Prabhu, you just said in sometime in between we can hold a US account when we even go back to India. Is it true?
Yes. Yeah, bank accounts you can keep remain open, no problem. And even this 401k account you can keep remain open, no problem.
Okay.
Prabhuji, when you said that we need to declare the investment that we have in India, is it also include the PPF that we include in?
Technically, yes. Technically, each and everything, single penny you have in India, where you are generating any income, you are supposed to. So technical answer is yes.
Okay.
Yeah.
Prabhuji, if the spouse is not working here in the US, and you are invested on her name, is this still to be declared here?
Yes, because she is part of your return if you are married filing jointly. So any assets in her name also need to be declared.
Prabhuji, one question, but I think the income that is earned in India, there is a certain limit. They don't tax over that, right? I mean, you don't
in
have
India, they will not tax.
No, not in India, here. So if you have certain, like they say that if you don't have 100,000, investment in India, you don't have to declare here.
No, that's not true. For personal returns, so there is a rule for filing certain forms. Like I will talk about that when we talk about taxation in great detail. So there are certain forms for which there is a threshold that if you have more than $100,000 assets outside, then you have to fill that form. But as far as declaring income and paying tax, every single rupee you earned outside of US, you are supposed to technically declare and pay tax on that in US.
Okay.
Yeah, Prabhuji, let's say I have a plan of going back. So in that case, shall I invest here in US or in India?
Yeah. So if you have definite plan to go back, then you can start investing in India if you're not done so far. So I just wait till 6 months you are in India to start investing in your name, because by that time then you will become resident Indian, and then without any hassles you can start investing. But till that time, you can take an indirect route of investing in your parents or siblings or anybody who is in India in their name, provided you trust and there are no issues, because you are dealing with money. So you have to be very careful. Because you will do it in your name, they are in total charge of it. So as long as there are no issues, you can take that route and you can invest in their name. Yeah.
There will be tax implications for them, right, Prabhuji?
Yeah, so it depends. So for example, parents. So parents are retired, they don't have any much income. So in India, they are already paying no tax or very low tax. So even if you invest in them and you generate some return out of it, still you won't be paying practically no tax or very less tax. So like I invest in my parents' name in India, because I slowly shifted all my assets from my name to my parents' name, because it's becoming too much headache for me to maintain it and declare it every year here.
So probably another thing, maybe you'll cover it in taxation. If you invest in India, do we pay taxes both in India and in America?
No, it depends. Like in India, most of the income is tax-free as far as NRI is concerned, if your status is NRI.
Okay.
So only if you have any resident, provided you are doing it through NRE account, proper channel. But if you do it through residential account, then you have to pay tax. And if you are doing mutual fund in your own name, then there is a TDS. So tax will be deducted at source if you are NRI. That's why I don't recommend investing in mutual fund in your name in India. And technically also most of the mutual funds don't even allow. The moment your KYC say you are a US resident, they will not allow you to invest.
Oh.
Yeah, but Prabhu, if you have an NRO account, they do allow you to invest in India.
Yes, but even most of the fund house restrict that because this ETFs laws, they don't allow because they become liable to report it to US government what you have invested. So they don't want to follow all those reporting and guidelines. So they don't generally allow. Even if it is an NRE account, they don't allow.
Yeah, bro, they don't allow. Recently, I was trying to do that with that HDFC in Life 99. So the moment I clicked that link, they said, since it's outside India.
Outside India, then So that's why I said that if you can do it in others' name, then it's fine. But in your name.
Yeah, because I do have some investments in India on my name on another account. So I will have to check.
So if existing investment, then it's fine. If you made prior investment before your KYC updated as NRI, then it's fine.
Okay.
But any fresh investment, they will not allow.
Okay. Okay.
Yeah.
Oh, they are allowing, Prabhu. Actually, I am in the process of doing that. They are allowing, Prabhu.
Only couple of I am aware of L&T, AMC, which allows. Franklin, which allows.
Parag Parekh.
Parag Parekh maybe. Yeah. So there are very few. But again, as I said, that you have a headache. You have to file extra forms and everything in US return every year the moment you have any assets outside. So that is why I'm not recommending. But if you can take care of filing,
is it very tedious, Prabhu?
Yeah. My experience is that I talk to many CPAs and everybody, nobody is clear. Those rules are in pages and pages and pages, and it's very complex. So even if you have to declare it, then it's complicated. So again, it's a technical thing. You won't get any problems, but again, why to take risk, unnecessarily? And then most of the time, if you have more than 5 mutual fund accounts, then you can't file it electronically because that forms run into 5 pages each. And for each one, you have to file a separate form. And then you have to file manual return every year. And as I said, that my return run into 90 pages. So I have to file both my federal and state. It's a big binder. I have to file every year. So not worth. Okay,
Prabhu,
so
one more question. Sorry, Prabhu, one more question. So once I retire, say I'm trying to retire in 2 years. So once I retire, say I try withdrawing from my 401k and I'm going to stay in India. So I transfer that money to India. Do I need to pay tax there?
Yeah, no. If it's already tax paid here, then if you transfer it, then you don't have to pay.
Okay.
Yeah.
But Prabhuji, do we have to report that in our tax filing when we transfer money to India?
If it is already tax paid, then if you are doing regular transfer, then they don't need to account. But in India return, you have to declare any US bank account details. So if you are having any accounts here, then at least those you have to mention in India return. Now they have introduced that section from last 2 years.
Like in US, we don't have to do FBAR or FATCA, any kind of documentation here. Do we have to do for any money transfer we send to India?
No, for transferring, you don't generally have to.
But anyway, I will be paying tax here, right, Prabhu? Before I will be paying tax and then withdraw. So I have to put the tax return here in US. So I have that,
So that's what I'm saying. Since it's already post-tax money, so no country charge you double. So you pay tax generally in one country only. So if you are paying tax in one country, then you don't have to pay in another country. So since your money,
that's a good thing.
Yeah. So you saved already in US, you paid tax already in US, then in India, you are not subjected to tax. And vice versa. If you paid already in India, but again, the tax difference you have to take care of. So that is the important point. So rate difference you have to take care of. So let's say in India, you paid 5% income tax and you take that money here, then here tax rate is higher. So then the difference you may have to pay here. So again, that's a technical, that foreign tax credit rules comes into picture. You have to calculate, you have to take credit for that foreign tax credit and all. So so that is again very little bit topic.
Complicated.
We can discuss for one whole session on that only.
Okay. Thank you, Prabhu. Thank you.
Yeah.
Hare Krishna Prabhu, one question I have on 401k. If both husband and wife have 401k from the company, you cannot do a traditional 401k, right?
Yeah.
Traditional
Yeah.
IRA. Right?
Traditional IRA is anyway not useful because in that you just invest in savings and that won't give you much return. So you can, in traditional IRA, you can invest only in savings or at the most CDs. So that won't give you any return. In traditional IRA, you can't invest in equity.
But you get tax benefit with that, right? With the
Yeah,
traditional
tax benefit. Yeah, tax benefit you get, but your money is not growing. So what is the point?
And what is this backdoor Roth IRA? Is there any benefit with that?
I have not heard of that term.
Okay.
I'm not sure what is that backdoor means. Because it may be Roth IRA, they may be calling it backdoor because you are taking some indirect route to invest in it. So I'm not aware, so I have to check.
Thank you, Prabhuji.
Yeah.
Hare Krishna, Prabhu.
Yes.
The rollover IRA, you can invest. Rollover IRA, you can invest in equity or no?
Yes, yes. Rollover is just you are shifting the account from one to another. As term says rollover. From here you are rolling it to here. That's it. Everything else remains the same.
So what's the difference between rollover IRA and traditional IRA?
No, rollover IRA is applicable when you shift from one account to another, like when you are switching jobs. So you are shifting from previous employer to the next employer. So both are 401k, but you are shifting it from one to another. That's why it's called rollover.
Okay. Yeah.
Hare Krishna, Prabhuji.
Yes, Prabhuji.
Prabhuji, what is Roth deferral?
So Roth is called deferral because you are deferring your tax. Because you are not paying, you are deferring your tax. Because in Roth IRA also, whatever growth you get, that tax you are going to pay only at the time of withdrawal. No, sorry, you don't have to pay any tax in Roth IRA. So deferral it says because I'm not sure because you may be like I don't want to speculate, Prabhu, because deferral generally means that you are delaying. So delaying the tax, paying off your tax. That's why these traditional IRAs are generally called tax deferral instrument because you are deferring your tax from, let's say, from this year to 30 years down the line.
Okay. But do Roth deferrals invest in some equities or stuff like?
I have to check because I am aware of Roth IRA, but this Roth deferral, this is something I'm not aware.
Sure. Okay. Thank you, Prabhuji.
Yes.
I don't know if it is the same name, but there's a difference between post-tax 401k and Roth 401k. In both cases, your deferral, meaning whatever you put in, is tax-free, but whatever you earned becomes tax-free only for Roth. If you put a post-tax 401k, say if you earned $5,000 extra, you pay $5,000 extra. But if it's for Roth 401k, you don't pay taxes on that for $5,000.
Right.
Yeah.
Right. Because in Roth, since you already paid your contribution tax on your contributions, on any growth, you don't pay any tax, provided you remain invested.
Because the Roth law states that you don't pay any taxes on the earning.
Right.
So while withdrawing, you don't pay any tax on that, is what you're saying?
Yes, if you remain invested till again same retirement age. There are some flexible rules in Roth IRA that you can withdraw for, let's say, down payment of your first house or child's education and some hardship or medical. So there are certain clauses where in which you can withdraw, but the contribution which you make, you can withdraw at any time because that is anyway your post-tax money. So you can withdraw up to that amount anytime, but any growth amount, if you want to withdraw, then again, it's subjected to rules because it is tax-free.
Okay, thank you.
Yeah.
Prabhuji, one more question.
Sure, Prabhuji.
So, say, as I said, I'm going to retire in 2 years from now. So, what would you advise to stay here in US or stay back, go back home, or any kind of advice that you are going to give on that subject matter? Or
yeah, so like short advice, Prabhuji, is that ask your heart and like ask yourself that where you can do your sadhana better, where you can devote your time better, and where you can remain focused better in your retirement years, because now that is the only objective. perspective, right?
Okay.
Whatever time is left, we want to remain focused. So whichever environment helps you, whether in US or in India, you take decision based on that, because now that is the priority.
Okay. Thank you.
Yeah.
Yeah, the reason why I asked is like, because I don't want this, I struggled all these years, okay?
Yeah,
I don't want this material thing blocking me from doing my sadhana.
So finally, it will always be better to remain in India because cost of living is much less, complications are much less. So from that perspective, that will be always better. You can live in one the cost you are living in US in India.
Okay, thank you.
So you will have a lot less anxiety financially, at least.
Okay.
Yeah. So I just want to cover a few more options on that. So as I said that you can invest in mutual funds in others' name, or you can invest in FCNR deposits if you have the US account, NRE account. So generally Indian banks FCNR rates are much better than the CD rates here. So here like CD rate for 1 year is maximum, it's around 0.8 or something. But in India, like IndusInd Bank is still offering 2.3% on a 1 year, 2 year CD. So it is still better than here, and it's dollar to dollar. So you don't lose anything, no exchange rate risk or anything like that. You deposit your dollar, it earns interest and you get back dollars. So you can make use of that if it fits your situation.
Prabhuji, what is this account again?
NRE, non-residential account. In India, you have to, as you become NRI, you have to open that NRO, NRE account with the bank. So from that account, if you can open FCNR FD, and then you can send money there, deposit, and then you can bring that money back US without any complications.
It's called FCNR
deposits, right?
And is it treated as same dollar, or it will convert to rupees?
No. FCNR deposit don't get converted to rupees. So they remain in dollar and you earn interest in dollar only.
I see. And whenever we wanted to just do a wire transfer,
yes.
Back and forth.
Yes, back and forth via wire transfer, you get it.
Thank you.
Yeah.
What is the advantage, Prabhu? Like, is the interest rate is more in India?
Interest rate, like here, if you do CD, it's like 1%, less than 1%. There, at least you are getting 2.3. But with HM Bradley, you are getting here 3%. So even in current situation, I won't advise.
Correct.
Yeah.
Here,
just mention that because that is an option. Just so that you are aware.
So here, what is that which is giving 3%, Prabhu?
I talked in the morning, that first session, HM Bradley high yield savings account.
Oh, okay.
So that is giving 3%. So we don't have to necessarily go for this FCNR deposit.
Prabhu, do we have recording of that first session?
Yes. Yeah, it's on the Temple YouTube channel.
Okay.
Krishna Prabhuji, one question, like currently I do like in India, so instead of on the NRO, like normal fixed deposit I open.
Yeah.
From the NRO account. So is there any difference between the FCNR and NRO? I know that NRO account, you won't be able to transfer the money back to US.
Right. So this is the next NRE term deposit. So there are two. So in NRO, if you have, as you said, that the two disadvantages of NRO. One is that you have to pay tax in India. There would be TDS in India on NRO account deposits. And then you can claim it as a tax refund, but still that will be deducted at source. You can't do anything about it. Second disadvantage, as you mentioned, that there are complications if you want to bring that money back to US. So you have to go through CA, you have to do all paperwork to convert that money from NRO to NRE, and then from NRE to dollar, and then bring it here. So better alternative, if you want to do rupee deposit in India, then better is NRE term deposit. So in this account, what it does, it convert your dollars into rupees. You open Indian FD deposits, let's say 5%, 6%, 7%, whatever the rates. Like IndusInd Bank right now offering 7% return, which is one of the highest in industry. Okay. So if you open term deposit like NRE FDs, then you are not subjected to tax in India, one thing. Second thing, you can bring that money again, convert it to dollar and bring it back here without any paperwork.
So what's the difference between FCNR deposits and NRE term deposits?
So FCNR is, FCNR is in dollar, it's deposited in dollar.
Oh, okay.
And NRE deposited in Indian rupees.
So, but you might get a little bit higher interest rate on the NRE
Yes.
terms? Okay.
Yes, but you are subjected to exchange rate risk. So let's say you converted your dollar in $74 when you did the FD, and now dollar is, let's say, 77.
Okay.
So when you bring it back, then effectively you may lose.
Okay.
So
thank you.
That is the risk. Yeah.
Prabhuji, do we need to declare this NRE deposits also in here?
In FBAR 8931 and any interest you earn on it, you have to declare here.
Like, do you have to pay taxes here for those deposits, Prabhuji?
Yes.
Or only just you have to declare them?
No, pay tax. Any interest, any income you generate, you have to pay tax.
Prabhu, one more question I forgot to ask.
Yeah.
This is Nataraj Krishnadas.
Yes,
I am having a property. Say if I sell that property when I'm old, so if I sell that property, say I get something like 30-40 lakhs, and I also won a green card, so I'm going to be going back and forth. So if I have that 40-50 lakhs, do I need to declare here?
I'm not too sure. Means that is again a specialized topic, so we need to consult some tax professional. Okay. But again, the technical idea is that any income or any profit you generate anywhere in US, once you become green card or citizen, then you have to file return every year in US. And so again, it would come into capital gain tax. So depending upon how long you have been holding on to it and how much is your real capital tax amount and how much tax you already paid in India on that once you sell it. So taking all those factors into account, it has to be seen that whether any tax need to be paid.
Yeah, it has been like close to 20 years that I bought that property. I didn't.
So it will depend. Yeah,
okay.
So it will depend like how much in Indian terms, because everything depends on the gain. So in Indian terms, is the capital gain based upon the inflation of India and all that. So first you have to arrive at that amount, and from that India charges tax on that, if at all. And then if you declare it here, then it will be determined based on that.
Okay, thank you.
Yeah.
Probably if we have a rental income from India, and we are getting that rent, so do we need to declare it in US and pay income tax for that?
Technically, yes.
Oh.
Yeah. I don't want to say bluntly no. So that's why I'm saying every time technically yes. So as per rule, it has to be.
Prabhuji, but if you are taking as a standard deduction and not a itemized, then still you need to declare it?
Yes, income is income. Deduction is just a way to manage your income and how much tax you paid. As far as income is concerned, income is income. It has nothing to do with your deduction.
But Prabhuji, we are paying in tax in India for that income, right? Rental income.
Yeah. So then, as I said, that you are not charged both places. So if you already paid some tax in India, then you can take foreign tax credit in US for that amount.
Okay.
Yeah.
Prabhuji, how does inheritance work? Prabhuji?
Sorry, can you repeat that?
How does inheritance work? Like if you inherit a house.
Inherit. Yeah, so for those rules are very relaxed, especially in US, like inheritance and estate taxes are very relaxed, like up to $1 million. If you inherit, you don't have to pay any tax.
So with that case, it's better if we buy a property or anything in parents' name, then we can claim it.
I will tell you when we discuss property, because this property is so much on everybody's mind from India. And I will tell you the pitfalls, because this property investment alone can make and break your both spiritual and material life. I will quote various examples.
Yes.
And after last class, at least I have got 4 or 5 different calls from devotees who are repenting that why they invested in property, and all their savings and everything is in property right now, and they can't do anything about it.
Yes.
So yeah. Okay, I think we are right on the top of the hour for this part. So are there any other questions?
How can we reach out, Prabhu? Your email or mobile, just in case if you have any follow-up.
Yeah, so I have emailed everybody who has registered. So you should have my email ID, and I'm putting my phone number again here. So just in case you want to reach out, it's both WhatsApp and direct number. Yeah. Okay. Are there any other questions to answer, we can discuss for now? Okay. So if not, then probably we can take a break now for an hour, and then we can regroup again, and we'll discuss like using all these vehicles which we discussed, like IRA, Social Security, and ETF and IUL. With all these, how we can achieve our goals like retirement goals and other things like owning a home and car and other stuff. So now we'll go into that and see how we can plan and achieve for each of those in next session.
Thank you, Prabhu. Hare Krishna.
Okay. Thank you so much. Again, very, very thankful to all of you for patiently listening. It's very, very, I'm very, very grateful. Thank you so much.
Thank you so much. Hare Krishna.
Thank you. Thank you.
For conducting this seminars.
Thank you, Prabhu.
Thank you. Thank you. Hare Krishna.
Thank you, Prabhuji.
Hare Krishna. Hare Bol.